In the late 2000s, the global financial system faced a massive collapse. Let's look at what the subprime mortgage crisis actually was. Subprime refers to lending money to borrowers who have a higher risk of defaulting on their loans due to lower credit scores. By 2008, the housing market bubble burst, causing a chain reaction that affected banks and retirement accounts all around the world. Banks issued risky loans, bundled them into investments, and sold them. When borrowers could not pay, these investments lost almost all their value. Prime loans go to borrowers with strong credit. Subprime loans were designed for those with weaker credit, usually at much higher costs. As prices fell, homeowners found themselves owing more than their homes were worth, leading to widespread foreclosures and bank failures. The crisis serves as a reminder of why risk management and transparent lending are vital to the health of the entire economy. Understanding our financial history helps us navigate the future. Thanks for watching, and feel free to subscribe for more basic money concepts.